What's up, everyone? My name's Henry, and I just want to go over some quick ways that I was thinking about you can make money in a neutral to bearish market. So usually when we have a neutral to bearish market, what everyone thinks about is just shorting a stock. And the kind of the downsides of that is that, there's unlimited loss potential, but also, say you short something at, 200 and it stays flat, and then you buy the cover back at 200. You haven't really made any money, right? So there are different strategies and different ways utilizing options to actually make money even though the underlying asset stays flat. So the first thing I want to get into is just the bear call spread. It's a very simple, just one leg strategy where you're selling an out of the money or at the money call, and then buying to hedge that naked selling of a call with another out of the money call. So this obviously creates a net credit, and max profit is whatever you receive to whatever you started the trade with. So if I sold this spread for $300, I can't make more than $300, right? So it's a very simple strategy, and you're going to make money, depending on how you position the strike prices when the underlying stays flat or even goes down. So that's obviously one of the most simple ones. Another a little bit more complicated one that's going to kind of create a range of profitability is called the Iron Condor. So basically, it's just a combination of the same bear call spread and then also with a bull put spread, and they're both going to be credit spreads. And basically, a credit spread to the upside and a credit spread to the downside smashed together, creating a range of profitability. Obviously, it's going to be hard for me to explain, but if you want to refer to the article or the website link below, you'll be able to see how these trades are structured and how the profitability kind of looks. But yeah, basically, it's just a combination of two credit spreads, and like the first example, the bear call spread, your net credit or whatever you receive at the beginning of the trade is going to be your maximum profit. Something that's going to be a little bit more complicated is called the butterfly call spread. This is, the buying of a out the money call and an in the money call financed by selling two calls at the money, or whatever strike price you choose. And the key thing to remember is that the strike where you sold the two calls is where you're going to have max profit. Okay, and this is just it's going to look very similar to the Iron Condor, where you have a range of profitability, right? But it's the range of profitability is going to be a little bit more condensed, and it's going to be a lot higher returns if you actually stay within the range. And the reason for this is because it's actually a net debit, so it's going to cost money to put this trade on, right? But there are high levels of returns that you can get specifically at the strike price of where you sold the two calls. So, there are examples that I have on the website or in the article where, this trade can get you like, a 4 to 7 bagger, basically. You're quadrupling your returns. But the thing is, it's going to take money to actually enter this trade. And profitability is very limited. The range is very limited, so there's a high chance of losing your whole initial investment if the underlying goes up too high or goes down too low. But yeah, that's basically a couple of different ways that you can make money in a neutral to bearish market, instead of just shorting something or going long inverse ETFs or whatever. It's just a little something that you can do on the side to create a little bit of, either collect a little bit of premium or make a little bit of money and just, try and hit and really with the butterfly spread, it's really a shot in the dark, honestly. But if you really have a strong investment thesis and have done a lot of strong technical analysis, and you really do believe that it's going to close within this range and it's going to close at a specific price, a specific day, there's a lot of money to be made. But yeah, so those are just a couple of simple strategies. The butterfly call spreads is not that simple, but the bear call spread and the Iron Condor are, simple strategies that you can put on with a little bit of cash that you have in the side and take advantage of, a neutral or a downward falling market. So thank you.